If you close the books under both US GAAP and IFRS, you know the month-end lease grind. The same population of leases, two standards, and an auditor who expects it to tie to the penny. I want to walk you through how I do that end to end on a real, genuinely complex contract, live, not slides, the actual engine. Here's the part people skip past. Lease accounting doesn't start with the lease. It starts with master data, your entities, cost centers, the GL chart, your IBR curves, FX rates, vendor, and tax data. So let me start where the close actually starts. It's month end. A few things just landed in my subledger, the way they do every month. Treasury posted the period end FX rates and refreshed the IBR curve. And out of the ERP came two new records, a new cost center, because we just opened a warehouse, and a new lessor in the vendor master. None of that is a lease yet. It's the foundation the lease is going to post against. So I bring it in from the ERP. I'm simulating that pull for this demo. In a live environment, it's a real integration, ERP or treasury feed on whatever cadence you run. And here's the foundation. This is a representative slice. Entities and cost centers, the GL chart, how each asset class routes to its own accounts, the IBR curve, FX, vendor, tax. The real set is far bigger. And notice the right-hand column. Each domain comes from its own system on its own clock. FX and IBR monthly. The org and vendor master as they change. Master data is a living thing, not a one-time setup. Master data is established. And now, only now, does the next layer open. You can't post a lease to an entity, an account, or a lessor that doesn't exist yet. That sequence is exactly how it works in a real enterprise, and most demos get it backwards. Here's a layer most tools bury: the master lease agreement. An enterprise doesn't sign one-off leases. It signs an umbrella agreement with the lessor, who the counterparty is, governing law, the window the agreement is valid for, and the end-of-term mechanics. How many days notice to return the equipment or vacate, to renew, to exercise a buyout. You negotiate that once. Every schedule executed under it inherits those terms. Enter once, propagate everywhere. And notice, pick an agreement and you see every lease contract booked under it. The system also won't let a schedule commence outside the agreement's validity window. That's a control, not a convention. Now the lease itself. Bring it however it lives today. Key it in through a form, import a workbook, or have a source system push it over the API. That flexibility is the point. Your data is where it is, and the engine doesn't care which door it comes through. I'll import the new warehouse lease. And here's where this is going. This is a versioned, governed REST surface. A source system posts the lease as JSON authenticated by key, and it runs the same validation and the same engine as the form and the workbook. Same schema, every door, one proof. Now the part everyone's asking about, AI agents. This subledger has a real MCP server. I can connect Claude to it, and the agent books leases, pulls the trial balance, runs the tie-outs. And here's the architecture point most people miss. MCP doesn't replace the API. It sits on top of it. The agent walks through the same door, hits the same validation, the same fence posts, the same audit trail. Every action it takes is logged, attributed to the agent by name. And when it tries to close the period, it gets the same 403 a junior accountant would. Agents do the work. Humans own the control points. That's what AI governance looks like in a subledger, not a policy PDF, a roll gate that fires. And this is deliberately not a softball. It's mixed class. The building and the equipment inside it, commencing on different dates, with initial direct costs, a lease incentive, and a rent-free period. This is the kind of contract that eats an afternoon and a stack of spreadsheets by hand. Watch it validate, run through the engine, and prove itself. There it is, top of the screen. The one thing your auditor cares about. Every period balances to zero. Proven to the cent. Same lease, 3 standards. The cash is identical, $328,000. The lifetime cost is identical, $321,000. Classification never touches either one. What changes is timing. Under ASC 842 operating, you recognize a level cost. Under ASC 842 finance and IFRS 16, it's front-loaded. Interest is highest early, then tapers. Same total, different shape, and the chart shows it. At the reporting date, the lease liability is $172,586.32. And it's the same under all three here because this lease has no purchase option. So the finance and IFRS treatments land in exactly the same place. The engine handles the case where they don't, too. And this isn't a forecast or a model. Here's the liability and ROU roll forward, the trial balance at the reporting date, and the actual journal entries. 828 lines under operating alone, every one of them tying out. This is what would post to your GL. And each standard comes out as a full workbook. Input echo, liability, and ROU schedules, journal entries, trial balance, maturity, disclosures. Formula-driven, every total tied out two independent ways. This is what you hand your auditor. Now step up a level. Everything so far has been one lease at a time, but your auditor doesn't want 18 separate workbooks. They want the disclosure note for the whole portfolio. Here it is, consolidated, straight off the same subledger. The maturity analysis, every lease's remaining payments bucketed by year, the way it prints in the footnote. The cost and cash tables, total lease cost and cash paid, split the way each standard needs it. Operating versus finance under US GAAP, by asset class under IFRS. The right-of-use asset and lease liability roll forwards. And the weighted average disclosures US GAAP asks for remaining term and discount rate. Both books side by side, and it ties out. Every figure computed two independent ways and proven to the cent, all the way back to the consolidated trial balance. This is the note your statements carry, generated, not retyped. And because it's generated, every number in that note stays alive. Take any line, say 1 year's bucket in the maturity analysis, and click it. It opens right in place to the leases behind it. Each contract's share of the figure pulled from that lease's own schedule, and they sum straight back to the number you clicked, to the cent. When your auditor points out a disclosure and asks, "Where did this come from?" This is the answer. The footnote isn't a table somebody retyped. It's evidence you can drill. One more thing, because every controller asks it, what happens to what I've already posted? Booking populated the subledger. Closing the period posts it. Watch. I close the period as controller, and only as controller. Flip the roll back, and the button is gone, and the server rejects the call independently of the screen. The period's journal lines are now immutable stored facts, like your ERP. Now the hard case. A remeasurement lands effective in a month I've already closed. The system never edits history. The posted months get flagged superseded, still visible, still auditable, and a period-by-period reverse and repost catch-up is staged in the first open period. Every catch-up line posts in the open month but carries the date it would have posted. That's the audit trail your external auditor actually wants. And if I reopen the period, most recent first always, the catch-up unwinds itself. 5 tie-out invariants prove the whole thing to the cent, anytime, on demand. And the posting tiles keep that honest. Look at the counts. Hundreds of superseded lines, replaced, but still on the books and still visible. And hundreds of catch-up lines, staged as reverse and repost pairs in the open period. Those aren't demo props. They're the live totals from remeasurements that landed in closed months. History was never edited. It was superseded in the open, and the machinery keeps score right on the screen. And the modifications that usually break a spreadsheet? The engine takes those too. Take this same warehouse contract, the building and the forklift inside it. Partially terminate just the forklift. Give up a third of it, so the rent steps down from $3,000 to $2,000 a month, and it runs on to term at the reduced rate while the building carries on untouched. The engine proportionately writes down that asset's right of use and re-amortizes what's left, handled the way each standard requires right down to where US GAAP and IFRS legitimately part ways. And it carries the completeness accounts of real close needs: security deposits, lease incentives receivable, prepaid rent, each unwinding to zero by end of term. Same discipline throughout. Every path proves to the cent. And you don't have to take the engine's word for whose math it matches. Built into the app is a reference shelf. 51 worked examples replicated from the published literature, the FASB codification illustrations, and published examples from KPMG, Deloitte, BDO, and EY, each tied to the figure its source printed, to the cent, page cited, an independent verifier behind every row. And read the note on screen. Those organizations aren't affiliated with this application and don't endorse it. The names simply identify whose published example the engine reproduces. And one newer layer underneath, the posting feed itself is now derived twice: a Python engine and the formula workbooks, independently gated cell identical before a single line can post. One more, because anyone with European operations will ask. This is the same warehouse contract, denominated in euros, on US dollar functional books. So IAS 21 and ASC 830 do their work. The lease liability is monetary. It remeasures to the period end spot every month and the FX gain or loss posts. The ROU asset is non-monetary. It holds the historical rate. And here's the detail an auditor actually checks. This contract's two assets commence 6 months apart, so each asset's ROU carries its own commencement date spot, not one blended rate. And it still proves out. Every period balances to zero, to the cent. And there's a second layer of currency that trips people up, because it's a different mechanism entirely. What you just saw was remeasurement, the euro lease on US dollar books, the liability revalued to spot. But if this entity's functional currency is the euro and it rolls up into US dollar group statements, you also have to translate. Different rule. The balance sheet at the closing rate, the income statement at the period's average, and the difference never touches earnings. It lands in other comprehensive income as a cumulative translation adjustment. Here's that overlay. Functional euros on one side, presentation dollars on the other, and the CTA posted to OCI. And it proves out two ways to the cent. The translation adjustment I book equals the movement I can derive independently. Remeasurement hits the P&L. Translation hits OCI. The engine keeps them straight, and so will your auditor. And here's the layer your auditor cares about most, because now I can hand them a seat, not a spreadsheet. This is a read-only auditor console. Same subledger, different chair. The auditor signs in, sees everything, changes nothing. Notice there's no book button and no close button. And it isn't just the screen hiding them. The server refuses a write from this role. Read everything, touch nothing. 4 things an auditor always asks for, and they're each a tab. The posted register. Every journal line that posted, including the ones we superseded, still there. The change log. Every change anyone made to this subledger. Who, which field, the value before and after, and when. Not a policy that says we log changes. The log itself. The close and reopen history. Every period close and reopen with the authority that signed it. And the export history. Because when the auditor exports any of these, the file comes out stamped with its own provenance, which query produced it, under whose role, at what moment. The spreadsheet in their hands matches this screen to the row. 1 query, 2 presentations. No retype tie-out to trust. So let me show you what the auditor actually does with that seat. It's fluctuation analysis. The classic audit move. Scan the P&L for anything that swings when it shouldn't. The financial reporting pivot keeps a shared library of saved views. And there's one built for exactly this. Every lease's monthly P&L, screened down to midterm swings of 10% or more. I load it. 1 click, and the whole portfolio has been screened. 19 leases went in. 11 rows survived the screen, and every qualifying month lights up yellow. Here's the one that matters. This warehouse contract jumping 16% in July of 2026. Midterm, where a lease cost should be level. A swing like that in the middle of the term almost always means one thing. The lease was modified. The report is even named for it, the modification radar. That's my selection. Time to pull the file. The fluctuation analysis found the smoke. The subledger has the fire. I open the lease itself, and there's the story in the journal entry feed. A payment modification, effective July 1st. The monthly payment stepping from 10,000 to 11.5. The liability remeasured, the right of use adjusted. The revised stream scheduled out to term, every line dated, every line tying out. 10 minutes ago, this was a yellow cell on a variance report. Now it's an audit trail. And when what you want is the story, not just the lines, ask Claude right here. The panel already suggests the question an auditor would ask, walk me through the accounting. Something changed on this lease. Now, this demo server deliberately holds no AI key. So watch what it does instead. One click, and it puts a complete lease-scoped prompt on my clipboard, pointed at this exact contract, with the steps to drop it into the Claude desktop app, where Claude connects to this subledger as a governed, read-only agent. And here is that exact prompt in the Claude desktop app, connected to this subledger through MCP as a governed, read-only agent. Watch it pull the explanation pack and answer with the journal line cited. Watch the tool calls stack up, the event history, the finance schedule, the July journal lines, everyone a governed read against the live subledger. And there's the answer. The July modification named, the remeasurement explained, and look at the citations. Every paragraph names the exact batches and journal lines it rests on, then proves the liability roll against the schedule to the cent. Not a chatbot summarizing, a governed agent reading the books. Every subledger controls who can touch the numbers. Fewer show you the control on that. Who grants the access in the first place? So here's Maker Checker on access itself. As access administrator, I can propose a permission change. Give this role that capability. But watch, it takes no effect until someone else approves it. I file it with a business reason, and it sits. Now I sign in as corporate controller, and there's the request, waiting. I approve it. And only now does it take effect through the exact role sets the server enforces. The person who proposes access can't grant it. The person who grants it didn't propose it. That's segregation of duties on the provisioning process, not just on the postings. And two guardrails. The ICFR critical controls, period close, the classification override, the right fences, are code locked. No approval from anyone hands those out from this screen. And on a cadence, we open a user access review. Every grant sitting above or below the code baseline gets recertified by the controller, item by item, and the campaign closes as auditor evidence. If nothing's been granted, it completes as a negative attestation, which is itself the evidence. That's the SOX ITGC access review, run inside the subledger instead of a spreadsheet emailed once a year. So that's the whole arc. Master data in, however it lives, and on whatever cadence it arrives. A genuinely complex lease captured against it. Dual standard numbers you can stand behind to the cent, and the work papers to back them. And here's the part I want to leave you with. Everything you just watched was built entirely with agentic AI, Anthropic's Claude, directed by a CPA. I didn't write a line of code. I supplied what an accountant supplies: the standards, the controls, the tie-outs, and auditor demands. The AI did the building. And it's built to carry a real portfolio. We measured it. Reporting that took 29 minutes at 1,100 leases now runs in about 30 seconds. And I'm not selling you this application. It's the proof of what's now possible. Your team can have a subledger like this shaped to your own portfolio, your own GL, your own close. That's what fractional AI lease controllers does. I help you build yours. If the close I just described sounds like your month, let's have a conversation.